Debt is one of the most misunderstood financial tools in the world. For many people, the word itself immediately brings thoughts of financial stress, monthly payments, and long-term obligations that seem impossible to escape. In countless situations, that reputation is deserved because debt used for unnecessary spending can create years of financial pressure. However, wealthy individuals often view debt through an entirely different lens. Rather than seeing it as a burden, they see it as leverage, a financial tool capable of accelerating growth when used strategically. The difference is not the existence of debt itself, but the purpose behind it. While many people borrow to purchase things that lose value over time, financially sophisticated individuals often borrow to acquire assets that have the potential to generate income, appreciate in value, or create future opportunities. One of the most common ways wealthy people use debt is for asset acquisition. Instead of financing liabilities that drain cash flow, they focus on purchasing assets such as real estate, businesses, or investments that can produce income. The goal is simple: acquire something capable of generating returns that exceed the cost of borrowing. If an investment creates consistent cash flow while the debt remains manageable, the borrowed money becomes a tool for wealth creation rather than a financial burden. This approach allows investors to expand their portfolios more quickly than they could by relying solely on savings, giving them access to opportunities that might otherwise take years to achieve. Another powerful use of debt is business expansion. Successful entrepreneurs understand that opportunities do not always wait for capital to accumulate. Rather than spending years saving money before growing their companies, many use loans or other forms of financing to expand operations, hire employees, purchase equipment, or enter new markets. When executed carefully, this strategy allows businesses to grow revenue faster than they could through organic expansion alone. The same principle applies to real estate investing, where mortgages allow investors to control large properties with relatively small down payments. Rental income can help cover financing costs while the property potentially increases in value, creating both cash flow and long-term equity growth. Wealthy individuals also use debt for tax efficiency and liquidity management. In many financial systems, certain types of debt offer advantages that can reduce taxable income or improve overall financial flexibility. Rather than selling valuable assets whenever cash is needed, investors may borrow against those assets while allowing them to remain invested and continue growing. This strategy preserves potential future gains and avoids triggering unnecessary taxes or disrupting long-term investment plans. By maintaining liquidity through carefully structured debt, they can access capital when opportunities arise without sacrificing ownership of appreciating assets. Another advanced strategy involves arbitrage, where borrowed money is invested in opportunities expected to produce returns greater than the borrowing cost. For example, if capital can be borrowed at a relatively low interest rate and invested in assets generating significantly higher returns, the difference becomes profit. However, this approach requires substantial knowledge, discipline, and risk management. Leverage amplifies outcomes in both directions. While gains can increase, losses can also become larger. This is why successful investors spend considerable time analyzing risk, evaluating cash flow, understanding interest rates, and ensuring that repayment plans remain realistic under different economic conditions. The most important lesson is that debt itself is neither good nor bad. It is a neutral financial instrument whose results depend entirely on the knowledge, discipline, and strategy of the person using it. For individuals without a clear plan, debt can become a trap that limits financial freedom. For those who understand financial systems, cash flow, risk management, and asset performance, debt can become a powerful wealth-building tool. The people who successfully use debt are rarely reckless gamblers, chasing quick profits. Instead, they are calculated decision-makers who understand both the opportunities and the risks involved. Wealth is not built simply by avoiding financial tools. It is built by learning how to use them wisely. Debt remains one of the most powerful examples of this principle, dangerous when misunderstood, but potentially transformative when mastered.